According to mainland Chinese media reports on October 9th, Weltmeister Automobile Technology Group, once a sensation in the automotive world, is on the brink of bankruptcy. Since October 11th, numerous owners of Weltmeister's new energy vehicles took to social media platforms, reporting issues with the car's official systems, Weltmeister Zhixing, and the Xiaowei companion Bluetooth key, as well as remote control functions, noting they were malfunctioning. The Weltmeister car mobile app displayed network abnormality, hinting that the back-end service might have stopped. Additionally, the official Weltmeister car service hotline went unanswered, and their website experienced loading issues. With the rise of EVs, a new challenge has emerged. As connected services become widespread, these key selling features turn into mere decorations when the vehicle companies face bankruptcy or leave the market. Many netizens realized that the issue isn't just about getting the car fixed after an EV company's collapse, it's that the car might not function at all. This is the immediate challenge facing nearly 100,000 Weltmeister car owners. Unfortunately, China's new energy vehicle industry seems to be coming to an end. The burgeoning automotive industry that emerged around the time of the COVID-19 pandemic has waned. Previously, NIO, Xpeng, Byton, and Weltmeister were collectively known as the four small dragons of the new automaking force. Weltmeister was best known for its M7 series vehicles, boasting as many as 32 surveillance cameras, including 3 LiDAR units offering zoom-in captures of nearby pedestrians and vehicles, and almost 330 degrees blind spot-free detection. In 2019, with the delivery of 16,900 vehicles, Weltmeister secured its position as the second highest seller among the new EV companies. However, in just 3 short years, their stature has dwindled, with this year's deliveries plummeting to 0. Data from China's business inquiry platform indicates that Weltmeister has applied for bankruptcy review. On October 10th, the company officially released a statement highlighting the challenges they faced due to the pandemic, including economic downturns, significant fluctuations in raw material prices, and difficulties in securing operational funds. Despite the dire circumstances, Weltmeister expressed hope to avert bankruptcy through negotiations and by attracting new investors. They promised to continue honoring contracts and responsibilities, ensuring high-quality service for customers, partners, and employees. However, the letter seemed more like a prelude to an official bankruptcy announcement. There are doubts about Weltmeister's capability to deliver quality services, especially with concerns over product safety. Given the current economic environment in China, it's increasingly challenging for emerging automakers. Although Weltmeister is hopeful of resolving its debt issues through strategic adjustments and acquiring new investors, risk reports indicate that the company's execution amount has exceeded 100 million yuan, $13.7 million, with equity in several of its holdings now frozen. Established in May 2012 by founder Shen Hui with a registered capital of 6 billion yuan, Weltmeister was fully owned by Suzhou Weltmeister Smart Mobility Technology Company. Currently, this 6 billion yuan stake is also frozen. There were hints of Weltmeister's impending bankruptcy. Previous reports from mainland media mentioned an internal communication from Weltmeister in February, admitting to operational difficulties with plans to optimize the organizational structure and reduce costs to seek survival. Financial woes persisted, and unpaid salary issues once again pushed Weltmeister to the edge. On February 26, rumors surfaced of Weltmeister employees at their Huanggang factory protesting unpaid wages. Furthermore, Weltmeister Automobile has been embroiled in criticisms over the quality of its vehicles. According to mainland Chinese media, several instances of Weltmeister cars catching fire have been reported in various locations, such as Beijing and Hainan, raising safety concerns among consumers. On September 24th, a video posted on Douyin showed a Weltmeister car emitting thick white smoke while waiting at a traffic light. A woman quickly escaped from the vehicle as surrounding cars hurriedly moved away to avoid harm. This is just one of the several instances captured in various videos highlighting Weltmeister cars catching fire. Another surveillance footage from April 18th in Haikou, Hainan showed a man charging his Weltmeister car at a station. Minutes later, the vehicle began emitting white smoke and subsequently burst into flames. A similar incident took place in Sanya on January 20th, as seen in this video. The car owner's family recounted hearing 2 sudden explosions while driving their Weltmeister, followed by a battery fault warning on the dashboard. Thick smoke was observed upon checking the rearview mirror. With such incidents becoming more common, questions regarding Weltmeister's safety standards have surged. Weltmeister's sales have dropped significantly. Based on information from Chinese automotive websites in 2020, Weltmeister's highest monthly sales reached over 3,000 units. This number rose to 5,000 units in 2021. However, in 2022, sales started to plummet, dropping to 153 units in November and only 30 by the end of the year. As of 2023, Weltmeister's sales have flatlined to zero. Reportedly, Weltmeister Automobile underwent 12 rounds of financing from A to D, raising over 35 billion yuan, $4.8 billion. The list of investors includes giants like Baidu, Tencent, Li Ka-shing Foundation, and the Stanley Ho family. Yet, despite such backing, the company faced several challenges, including executive resignations, frequent vehicle combustion incidents, the president's extravagant annual salary of 1.2 billion yuan, and allegations of brand design plagiarism. There are rumors, as shown in this Douyin video, suggesting Weltmeister's president has now left China for Munich and will later relocate to New York. With Weltmeister's closure, car owners face a new challenge: maintenance. With the manufacturer no longer providing services and parts, repairs have become a significant concern. According to this video, since 2022, Weltmeister has been grappling with issues like salary reductions, store closures, and halted production. Its two production bases in Wenzhou and Huanggang, with a combined capacity of 250,000 vehicles, are now inoperative. The video reveals a deserted Weltmeister factory in Wenzhou with relatively new equipment, indicating it wasn't operational for long. The video shows that many car owners who purchased this brand went to full-service shops for repairs, only to be informed that parts were unavailable and restocking times were uncertain. The manufacturer's customer service was either unreachable or, when contacted, they couldn't resolve the issues. Furthermore, many Weltmeister car dealers in several cities had already pulled out early, leaving car owners struggling to find representatives to address their concerns. In recent years, several minor brands among mainland China's vast array of car manufacturers have collapsed. He Xing is the Director of Quality Assurance at the Defective Product Management Center of China's State Market Regulatory Administration. He stated at the China Healthy Car Research Project seminar that over 40 brands have officially exited the Chinese market, filed for bankruptcy, restructured, or ceased their automotive operations in the last 5 years. Although Chinese government regulations mandate that manufacturers ensure a 10-year parts supply after exiting the market, enforcing such requirements remains challenging. Particularly as brands and dealerships face potential bankruptcies, these stipulations become harder to implement. Even when other groups take over post-exit, the probability of part shortage rises, especially for less common models. Therefore, after Weltmeister's collapse, supplying parts to consumers seems impossible. Lastly, sales of other mainland automakers have also seen significant drops. From October onwards, various car companies in mainland China started releasing their Q3 sales data. While Tesla leads the new energy vehicle industry, reaching a sales target rate of 73.6%, many automakers barely reached 40%. As reported by the paper, in the first 3 quarters, both Tesla and BYD achieved sales target rates of around 70%. Specifically, Tesla delivered 435,100 units in Q3, a year-on-year increase of 27%, with a total of 1.3 million units from January to September. Tesla recently reiterated its annual delivery target of 1.8 million units. In contrast, BYD's total passenger car sales this year reached 2 million units, a year-on-year increase of 76%. With an annual sales target of 3 million units, their target completion rate stands at 69%. In the first 3 quarters, the sales of new energy vehicles from leading new automotive forces like Li and traditional automakers generally accounted for about 40% of their annual sales targets. Li Auto reported sales of 244,200 units against an annual delivery target of 300,000 units, which is 81.4%. However, Li Auto's CEO, Li Xiang, previously revealed that the company's initial internal annual delivery target was 360,000 units. It was only after examining market forces that he adjusted the target down to 300,000 units, which subsequently impacted the supply chain. Furthermore, NIO delivered 110,000 units with an annual sales target of approximately 250,000 units, achieving 44% of its target rate. XPeng Motors delivered 81,400 units against an annual target of 200,000 units, a 41% completion rate. SAIC Motor reported sales of 648,900 units, representing a completion rate of 43%. Chang'an Automobile had sales of 306,700 units against a yearly goal of 400,000 units, achieving a 77% rate. Geely reported sales of 299,900 units with a yearly target of 600,000 units, reaching a completion rate of 50%. Great Wall Motors sold 170,300 units against a yearly target of approximately 400,000 units, marking a 42.6% completion rate. Prominent automaker Beijing Hyundai, due to plummeting sales, began selling off its factories. Beijing Hyundai's Chongqing plant was first listed for sale on August 11th of this year with a transfer base price of 3.68 billion yuan. However, the sale was not finalized by the deadline. Later, BIAC Group relisted it for sale on September 27th, reducing the base price by 1.1 billion yuan to 2.58 billion yuan. This reduced price is equivalent to a third of the total 7.75 billion yuan invested when the plant was built. The Chongqing factory, opened by Beijing Hyundai in 2015, was the company's fifth in China. At the time of its construction, Beijing Hyundai was experiencing continuous sales growth and had aggressive production plans. Data shows that from 2013 to 2016, Beijing Hyundai's annual sales consistently exceeded 1 million units, making it one of the few joint venture automobile companies in the country to cross this threshold. In the same year that the Chongqing factory was established, a fourth factory was opened in Changzhou, Hebei, with a planned capacity of 300,000 units. Insiders revealed disagreements between the Chinese and Korean sides regarding the new plant's location. The 2017 THAAD missile defense system dispute between China and South Korea marked a turning point for Beijing Hyundai. To protect itself from threats from North Korean nuclear weapons and missiles, the U.S. deployed the THAAD system in South Korea. The move was seen by the Chinese military as undermining China's nuclear deterrent capabilities. As a result of the ensuing diplomatic tensions, Beijing Hyundai, a joint venture with South Korea's Hyundai Motors, saw its annual sales plummet by 27.8%, dropping to 816,000 units. Since then, Beijing Hyundai's sales have continued to decline. With Beijing Hyundai gradually losing its market share, by 2022, its annual sales had dropped to 284,000 units. There were reports that, due to sluggish sales, Beijing Hyundai's 5 factories with a combined capacity of 1.65 million units have come to a halt. In 2019, Beijing Hyundai's first and second factories in Shunyi reported cessation of production. In 2021, Li Auto took over the first Shunyi factory of Beijing Hyundai. In 2022, there were rumors that the Changzhou factory might be sold to Xiaomi Auto. This year, under intense market competition, Beijing Hyundai faced increasing sales pressure. According to data disclosed by Beijing Hyundai, sales in the first half of the year amounted to just 123,000 units. He Xin, director of China's State Market Regulatory Administration, recently stated at the China Healthy Car Research Project Symposium, according to incomplete statistics, in the past 5 years, more than 40 car brands have formally exited the Chinese market, declared bankruptcy, restructured, or ceased operations. A report on the website of U.S. management consultancy firm Oliver Wyman indicates that the decline in China's car sales is much more severe than the impact of the coronavirus, economic slowdown, or even trade tensions with the U.S. Due to some structural changes in the market, sales of new passenger cars in China may remain below expectations for several years to come. The once accepted vision of selling 28 million cars annually by 2025 might only be realized by the end of this century. In fact, a significant number of new energy vehicle companies have gone bankrupt in recent years. Local media reported that on June 26, the Tongling Intermediate Court in Anhui Province declared bankruptcy for Qidian Intelligent New Energy Vehicle Company, based on applications from 10 creditors led by a company that had received over 17 billion yuan in financing. Letton Automobile, which prided itself on being a domestic high-end independently developed electric vehicle brand, claimed to have established China's highest standard manufacturing workshop for 4 major processes, with an annual capacity of 750,000 units. However, this year, they were involved in nearly 100 civil cases, mostly as the defendant, related to contract disputes involving sales, loans, etc., with a total executed amount of 40.9 million yuan. In May 2023, the People's Court of Changle County, Weifang City, Shandong Province, publicly announced a bankruptcy review case for Letton Automobile. In November 2022, Foton Motor Company declared the bankruptcy of Borgward Group, a Chinese-German concern. On November 3, 2022, GAC Fiat Chrysler Automobiles Company officially applied for bankruptcy to the Intermediate People's Court of Changsha, Hunan Province. GAC FAC, along with the Jeep brand, will divest from the joint venture model and exit the Chinese market. Green Drive Automobile, one of the earliest Chinese EV companies, had its business license revoked by the Qingpu District Market Supervision and Administration Bureau of Shanghai in May 2022 due to financial issues. Evergrande Auto, which had consistently lost nearly 110 billion yuan over the past 3.5 years and was already mired in a severe debt crisis, saw its market value plummet from a peak of 780 billion Hong Kong dollars to around 5 billion Hong Kong dollars. From the end of 2017 to the end of 2022, Evergrande Auto accumulated a loss of 98.9 billion yuan. The semi-annual report revealed that Evergrande Auto lost another 6.8 billion yuan in the first half of 2023. This means that since the cross-border car manufacturing began at the end of 2017, Evergrande Auto has accumulated a loss of 105.7 billion yuan. In terms of debt, at the end of 2022, Evergrande Auto's total liabilities reached 183.8 billion yuan. Of this, the outstanding matured debt totaled 11.6 billion yuan, overdue commercial bills amounted to 18.5 billion yuan, and cash equivalents were only 220 million yuan. Meanwhile, the company's total assets stood at 115.2 billion yuan, with liabilities exceeding assets by 68.6 billion yuan. With Evergrande's boss being arrested on charges, the company's eventual outcome is now a foregone conclusion. In summary, China's new energy vehicle industry is on a decline. This downturn can be attributed not only to the long-term repercussions the Chinese Communist Party's extreme policies over 3 years have inflicted on the nation and the industry, but also to the rise in raw material prices triggered by the broader economic climate and market instability. Evidence shows that without establishing a strong foundation and emphasizing product quality and safety, relying solely on a great leap forward approach of rapid and short-term gains merely feeds the delusions of the arrogant. The numerous bankruptcies in the new energy vehicle sector are foretelling the inevitable downfall of the automotive industry under the Chinese Communist Party's rule.